All right, let's jump right into this explainer. We're unpacking some pretty bold claims making the headlines lately about an impending AI market crash. I mean, are we really standing on the edge of a cliff here? Well, instead of panicking, we're going to treat these dramatic warnings as a thesis to be carefully examined, rather than a certainty to be feared. We'll be looking at hard economic data and historical precedents to really separate the hype from the reality. So to set the stage here, take a look at this quote from Jeremy Grantham. For a little context, Grantham is a legendary institutional investor. This is the guy who predicted both the dot-com crash in 2000 and the 2007 housing collapse. So when he suggests that the current market dynamics are completely out of historical alignment, it's the perfect stage for our analytical zoom out today. To unpack all these claims, here's our roadmap. We are going to cover the AI bubble hypothesis, anatomy of market manias, the AI productivity gap, some broader environmental impacts, and finally, strategies for uncertain times. Let's get right into it. Section 1. The AI bubble hypothesis. Okay, so prominent investor Michael Burry is arguing that the massive AI revenue we see flowing through major tech companies right now might actually be distorted by a temporary benchmarking phase. And he uses a very specific, kind of fascinating economic concept to describe the psychology of this current market. Let's pause and define what he actually means by that. Right, so what exactly is a bezel? The term was actually coined by the economist John Kenneth Galbraith, and the crucial point here is that in a bezel, the money and the assets feel entirely 100% real to everyone participating, right up until the exact moment they suddenly don't. Bearish investors are arguing this is exactly what's happening with AI demand today. Sure, the revenue seems infinite right now, but they're asking the hard question, does this just reflect a temporary phase of deployment that's eventually going to hit a brick wall? And that brings us to Burry's second mechanism, which is brilliantly illustrated by the bullwhip effect. Imagine hyperscalers over-ordering just out of pure FOMO, fear of missing out. You've got companies like NVIDIA locking in a reported $119 billion in custom supply commitments with manufacturers like TSMC. The entire supply chain is betting that this demand is permanent. But if it's actually just a temporary training phase, well, that whip snaps back with some pretty devastating financial consequences. Moving on to Section 2, Anatomy of Market Manias. To really ground these modern warnings, we have to look back at history. Great bubbles almost always form around genuinely important world-changing ideas. The internet absolutely changed the world, right? But the sheer overinvestment still drove a massive crash where the Nasdaq dropped by 82%. Early Amazon fell by a staggering 92% before it eventually inherited the retail world. It's the same story in 1989. Japan had the best manufacturing tech on the planet, but it was trading at an absurd 65 times earnings. It took 35 years for that market to fully recover. The takeaway? Transformative technology does not automatically immunize a market from a speculative bust. In fact, Michael Burry explicitly calls today's market a Cisco moment. Back in the late 90s, Cisco's technology was absolutely real and essential, for sure. But the assumption that telecom companies would just keep buying networking equipment at peak volume forever, that was flawed. Today, roughly 50% of NVIDIA's data center revenue comes from a highly concentrated group of buyers. Think Microsoft, Google, Amazon, Meta. If even one of them cuts their massive capital expenditures, the ripple effect is going to be immense. Now, of course, bullish investors counter this. They argue that, unlike the telecom boom, AI demand is driving immediate, quantifiable efficiency gains across software ecosystems, which they say makes NVIDIA's revenue fundamentally more durable. 784%. Let that sink in for a second. This massive figure represents the surge of the current top 10 AI stocks over a recent 12-month period. To put that into perspective for you, at the absolute peak of the dot-com bubble's euphoria, the equivalent top cohort surged 622%. So, by this metric, at least, the current AI infrastructure trade has been running significantly hotter than the most extreme phase of the 1990s tech bubble. All right, Section 3, the AI productivity gap. Let's step away from the stock market hype for a minute and look at real-world data. According to objective reports from the World Bank, actual AI adoption remains highly concentrated. Less than 1/5 of U.S. firms are actively using it, and that's mostly limited to white-collar knowledge workers. Plus, developing economies account for less than 1/4 of global data center capacity. So the structural reality we're facing is that translating these exciting, task-level AI improvements into actual economy-wide productivity gains, it's proving to be highly uncertain and pretty slow. And as you can see from this World Bank data, there are very real macroeconomic constraints at play here, showing that periodic financial volatility is a major risk. When you combine so far limited real-world productivity gains with historically massive investments in computing power, you create a really fragile equilibrium. A sudden reassessment of asset prices or a broad-based decline in equity markets could severely dampen overall business investment and consumption across the board. Which brings us to this really fascinating structural shift. In the past, companies like Apple, Google, and Tesla enjoyed relatively clear monopolies in their own lanes. Smartphones, search, EVs. But today, the Magnificent Seven are all putting on their armor and girding for battle in the exact same AI marketplace. They're taking on massive capital expenditures to fight over the very same territory. And honestly, without massive organizational changes and skill adaptations globally, the return on those investments could remain incredibly modest. Section 4, Beyond Markets, Environmental Health. Now, Grantham's analytical worldview actually extends way beyond just the stock market. See, while our highly efficient capitalist system focuses heavily on short-term financial achievements and quarterly earnings, Grantham is warning that we are ignoring the fundamental baseline of our economy, the actual health of our communities and our environment. Because if demographic stability fails, the underlying engine of compound economic growth fails right along with it. Relying strictly on the current scientific evidence, and keeping in mind that debates are definitely ongoing in the scientific community, there is a growing, serious concern here. We're seeing significant ongoing declines in global birth rates alongside a massive proliferation of microplastics and everyday chemicals in our food and cosmetics. Grantham points to research suggesting these environmental toxins are directly impacting human fertility. He sees this as a severe, creeping threat to our long-term societal stability. This statement right here is so powerful and really underscores his belief. For those who don't know, Silent Spring was the landmark 1960s book that exposed the dangers of pesticides. Grantham believes humanity must urgently create a less toxic, more supportive environment for future generations. Because simply put, without a healthy population to drive consumption and innovation, debating whether tech stocks are slightly overvalued becomes entirely beside the point. Finally, Section 5, Strategies for Uncertain Times. So how do we substitute panic with informed, rational analysis when we're navigating these highly speculative economic waters? Just for the sake of critical thinking, and let me be clear, strictly not as personalized financial advice, Grantham suggests a defensive approach of extreme diversification. As you can see, he recommends moving away from highly concentrated U.S. tech stocks and looking at wholesome bonds, cash, global non-U.S. equities, and precious metals like gold and silver. The logic here, which is backed up by analysis from institutions like Standard Chartered, is that during periods of stress or stagflation, where you might see low real interest rates and stalled economic growth, traditional assets take a massive hit. This prompts a strategic pivot to the safety of precious metals and bonds, essentially buffering your exposure to a potential massive drawdown in tech. Let's pause to define forward PE, or price to earnings. Because understanding valuation metrics is literally how you objectively spot a bubble. Grantham tells this incredibly revealing story from 1999, where he asked 400 financial analysts if the market dropping from a speculative 31 times earnings back down to a historical norm of 17 times earnings would guarantee a bear market. Every single analyst agreed it would. But when he asked if they thought it would actually happen, less than 1% raised their hand. They completely ignored the math in favor of the momentum. And this is exactly why you have to do your own independent research. See, the major investment firms and institutional advisors are structurally incentivized to remain entirely optimistic. Advising clients to pull their money out of an overpriced market results in a massive loss of management fees for them. At the end of the day, their financial incentive structures are simply not aligned with your personal capital preservation during a speculative peak. So by understanding the mechanics of market manias, keeping a close eye on true economic adoption data, and really examining the structural realities behind the headlines, you now have the tools you need to navigate these complex economic shifts. You don't have to operate out of fear, but you also definitely don't have to buy blindly into the hype. It is all about critical thinking, diversification, and asking the hard questions. So I'll leave you with this. Amidst all this noise, how will you filter out the hype today to build a resilient strategy for tomorrow? Thanks for joining me on this explainer, and keep learning.